So we'll get into the session. So before getting into the session, a quick introduction about ourselves. We are Consulting and Beyond, one of a leading audit firm in Chennai. We provide various services across different sectors. Our expertise in financial advisory and management consulting services. With 25 years of experience across various sectors, we have offered best services to our client, which helps them to increase their sales multiple times. Also, their profit was maximized in their best level. So to know more about it, like our business verticals are like four types of business verticals are there: audit and assurance, management consulting, corporate finance, and tax advisory. So the backbone of today's session is Umesh Gulecha, partner, Mrs. Ratandeep, partner, myself, Ramakrishnan, Sudarshan, Ajay, and Pratiksha. Also, I would like to thank all the other members who helped in preparing this PPT, also for the presentation. So we'll get into the today's topic. So the today's topic is how to earn more from your businesses. It is obvious that every entrepreneur wants to earn more from the businesses. See, for example, an entrepreneur wants to earn rupees 10 crore as net profit for this financial year. But only few entrepreneur is able to achieve the target of earning 10 crore as net profit. The question lies here is why few few people only is able to achieve the target of 10 crore as net profit. Why some many entrepreneur is not able to achieve this target? First and foremost, we need to learn why and where are all the possible areas is in the business where we falls. So basically, we need to understand the pitfalls in the businesses so that it will give us the idea and guarantee that where we are and what we need to do so that we can increase our revenue multiple times so that our profit also grows multiple times. So to know more, we need to identify what are all the pitfall or in a simple term why many businesses are fails. So reason behind why most businesses fails, once we understood, so it will give us a better position to know where we are and what we need to do. So the first and foremost thing is working based on assumption and intuition. It is like many entrepreneurs are they take the business decision based on their assumption and intuition. See, business decision should not be taken based on their assumption or intuition. It should be taken purely based on their numbers. It should be purely based on the planning format. It is like you need to know how much you wanted to reach as a sales target. You need to know how much net profit you wanted to know. So you need to have a proper structured plan. You need to be there, and whether am I targeting? Am I in the right path to achieve that one or not? So all the business decision needs to be taken based on the proper planning only. So it should not be based on the assumption or intuition. Yes, sometimes assumptions or intuition will go right, but many a times in the business scenario, the decision which we are taking based on the assumption may fall or will not give the desired results which we wanted. The second thing is drivers of revenue not focused. See, the topic for the day is how to earn more from the business. So it is like everyone wants to know they wanted to increase their revenue multiple times. If they have to increase their revenue multiple times, they need to know what are all the key drivers of their businesses. See, if the key drivers of the businesses, if a businessman knows, and if we focus on, then definitely he can multiple his revenue, also his profit he can multiple. For example, in the case of retail industry, if a businessman wants to earn more profit, so first you need to understand what are the key drivers. In the case of retail industry, so first key driver is footfall conversion ratio. The second key financial driver is average basket size. For example, in the case of footfall conversion, if he needs to know how many customers are walked in today and the customers, how many customers I have turned into sales number. Like for example, today 100 customers are walked in. I'm able to build 100 customers out of 100 customers. If I able to build 90 customers, so that is called footfall conversion ratio. In the same manner, we need to know what is the average basket size also. That is, if 100 customers walks in, they are able to averagely, if one person is able to bill 1,000 rupees, and our target is to we should have a target to increase to 1,200 rupees. So if you're able to increase 1,200, that is slight increase of 200 per customer, will help us to grow our revenue multiple times. See, you can see 200 rupees for a customer, so that may be a smaller number. If you see 200 into 100 into 365, so that will be a very big number. You wanted to grow your business, you need to know what are all the key revenue drivers you need to focus upon. If you know what are the key revenue drivers you need to focus upon, then you can plan your businesses accordingly and you can take your decision accordingly, so that you can increase your revenue sources and you can multiply your revenue. So the next thing is too much focus on achieving the sales number. It is like so as we started with saying 10 crore as a net profit to be earned for this financial year. See, if I have to earn 10 crore as a net profit with a sales target of 60 crore, it is like easy. See, everyone can easily earn 60 crore sales. I can earn 10 crore as a net profit, but many people will not be able to do it. The reason behind is they are not properly planning their expenses. It is like when you focus more on your sales number, sales target, so you often forget what is your result. So your end result always should not be the sale number, it should be your in net profit or the revenue which you are earning, which will be available for your future courses. So only stressing upon your sale number will not give you the proper result. So sale number is essential, but at the same time, what is more essential is you need to know how much net profit you wanted to earn. So in this case, you are making a sales of 60 crore, but you want a profit of 10 crore. So your expenses should be planned in such a manner that if I wanted to earn 10 crore profit from the sale of 60 crore, then how much expenses I need to properly I need to maintain, and which will help me to take revenue that is a net profit of 10 crore. So in this case, a quick formula is sales minus your net profit is equal to the amount available for your expenses. So you need to plan in such a manner that sale, how much amount you wanted to earn as a gross margin, how much amount you wanted to as a net margin, then this will number, the eventual number, the resultant number should be the expenses number. So if you operate on this line, you will definitely, every businesses can gain most of the money which they decide to achieve. The next thing is failure to analyze where and what competitors are doing. Yes, it is very crucial that when you want to earn 10 crore as net profit, so only you focus on your internal structure, your internal reviews alone is not important, is alone will not give the desired result. You have to see the external factors also. So externally, if the competitors are what they are doing and what is their strength, so we need to analyze based on their strength. So for our businesses, we need to create a SWOT analysis. What is our strength? What is our weakness? What is our opportunities? What is our threat? So if we can properly map all our SWOT, and if we can able to take action upon each and every factors of our SWOT analysis, which will eventually help you to increase your revenue multiple times. End of the year, you can achieve your target of 10 crore as net profit. So also you focus on you are focusing on competitors, but you whatever the business you are performing, it will reach to a saturation level some point of time. So upon saturation level, what we need to do is we need to think for the product mix. So what are all the new product I can incorporate into my business so that I can increase my revenue, also I can increase my margin. Also, with the existing customer segment alone, I'm not able to earn the profit which I am desired to earn. So I need to think for new customer segment, new market, where new market locality will help me to increase my revenue. So these are all the key metrics in which you, as a business entrepreneur, needs to take a decision. Then is lesser focus on working capital management. It is like every business owner is say, assuming the business which we are talking about earned a 10 crore as a net profit. But what happens at the end of the year? The business owner is coming and talking to us, sir, I earned a 10 crore as net profit, but I'm not able to see my 10 crore as profit in my in my bank balance. So the reason being is the 10 crore profit was invested purely in the business itself. That is, they have invested in working capital. So what happens is if you have invested more of your earned profit in your working capital, so which will eventually what to say, it will drain your cycle. So the lean working capital management will help you to earn multiple times of your revenues. So whatever the earned profit you have, no, so that needs to be properly planned and properly executed for working capital management. So in a simple line, lean model of working capital will help you to grow further. Then responsibility not assigned to employees. It is like, see, we have a target of earning 10 crore as net profit and target of 60 crore as sales. That is like only the management, only the owner alone have this target. Mean will not be that will not resultant. That will not be turned into result. So if you have to turn the your desire into result, what you need to do is you need to percolate whatever your action, whatever your plan into action. That is, you need to assign for all your key employees. That you need to assign all your key employees a target, and for all key employees, you need to have a KPI. Against KPI, you need to monitor whether whatever target is set, whether they have achieved or not. So proper monitoring of sales with KPI and the achievements of target will help you to multifold your revenue, multifold your growth of capital. That is revenue, your net profit. The important point is lack of planning for your growth capital. That is, yes, you have earned a 10 crore, but as we spoke no earlier, it was like you have invested in your working capital. So what happens is you don't have proper fund for your business growth. So what will happen is like even though you have earned a 10 crore as profit, if you wanted to open your new store in new locality, you have to borrow fund from outsider. So it is like you have earned a good profit, but still you rely on outsider to fund your businesses. Means the business is not in the proper shape. So what you need to do is you need to plan your growth capital also. Whenever you earn a profit, whenever you earn a surplus, so always plan your growth capital. Like if I have to go for new market, I have to look for new customer, I have to look for new product mix. Then for all these purposes, I need to have a growth capital. So this growth capital will help you to maximize your potential to earn more revenues. So the next point is no formal documented budget. So as we started, no, so like all the business decision needs to be taken based on the proper structured document and proper structured plan. So if any business decision needs to be taken purely based on budget or proper document only. So it is important that every successful business needs a proper documented budget is necessary. If they have proper budget, which will help them, which will guide them where they wanted to reach, where they are, where they wanted to reach, at the end of the year, they'll achieve their desired result. So the only the budget is alone is enough. No, you need to regularly, you need to review your budgets also properly, so that you can whatever the target you have kept, you have achieved or not. You need to properly, you need to review. So it is like you need to review your budget periodically. So suppose you set a target of quarterly or you set a target of monthly. You need to review periodically to check whether you are in the right path or not. The last and important thing is you need to have a flexibility to change your budget when need arises. See, it is like as we spoke, like you're expanding to a new market or you have opened yet another store. So means you have increased your revenue. So that increase in revenue needs to be planned in the businesses, so that how much is the increase in revenue and how much is the increase in net profit is going to come. So we have planned it properly, so that this will help us to grow further. So rather than just merely creating a budget and proper review will not give you the proper result. So you need to have a flexibility and willingness to change budget. But that doesn't mean that always you need to change the budget if you are not able to achieve your target. Then okay, change the budget. So that is not the case. If you have to change the budget, it should be purely based on the merit. You are going for new market, you are going for new segment. So then flexibility of changing the budget is arises. Then you need to change your budget. So these are all the key metrics every businessman needs to follow so that they can achieve the desired results they wanted to achieve. So in a simpler line, I wanted to summarize all these points. Means so business is not about magic or luck. It is about careful planning and effective execution. So you wanted to grow more, or you want to increase your revenue multiple times, or you have to increase your profit multiple times. So it all lies in your proper planning. With the proper planning, how you are properly, effectively, or executing the plan. So that there lies a key important point. So keeping in this line, so our team member will explain what are all the key things you need to plan it. So I'm handing over my session to Pratiksha. Thanks.
Thank you, sir. Now we'll start with how do you plan your growth? Before that, we need to talk about earnings. We need to talk about direction. That starts with goal setting. So, every successful businessman has a mantra of planning their business ahead. In that way, they'll guide your time and energy towards outcomes. For example, if your goal is to earn a 10 lakh profit in a year, you must break that into smaller actionable targets so that you can have a track on your targets. So it's a time for an activity. There will be a poll popping up. I request you all to answer. So the question is goal setting limited to finance department? Yes or no? Okay, so 69% of you guys have answered no, which is correct because there is an assumption where the finance
Hey,
department there is an assumption that department is responsible for budgeting and everything, which is not true. All the departments should contribute their works so that individual goals of all the departments clubbed together will get the organizational goal achieved. So this collaborative approach will help us ensure that the budget has been aligned with the organizational goals and it has been achieved regularly. As I said earlier, goal setting is telling your money where to go. That is directing your money where to go rather than wondering where it went. So there are certain steps you have to take while planning. The first step is that setting your objectives and target. Once you have specified your objectives and targets, you'll have to identify and quantify your financial outcomes. That is, you can't just say, I want to grow, I want to earn more. Instead of that, start specifying your goals. I want to earn 5 lakhs by this quarter so that your business will aim to achieve within that time frame. After that, the goals are set. You have to check the financial health and the growth because we are not just here for surviving. We'll have to sustain for a longer period. So we'll have to set goals in such a way that will lead to long term growth. Now let us look into the importance of goal setting. The planning will help us to know where our business currently stands and where we aspire to reach. This will also help the management to clearly set sales target as well as profit targets. Planning on working capital. So when you have already planned your working capital, this will help you in ensuring that there is no lag in your day-to-day operations and there is no financial stress. Business expansion plans. In case there is any future plans of expanding, since we already have a clear vision on our targets, it would be easier for us to know whether the resources have been properly allocated. So, focus areas in goal setting. There are certain financial metrics that we'll have to consider while setting targets. The first one is sales. Sales is important as they drive revenue from revenue. Gross margin. Gross margin indicates the profitability before expenses. Expenses have to be monitored regularly so that we can ensure cost efficiency. Net profit margin. This will provide an insight on overall profitability and your financial health. Working capital cycle. This will help you manage your liquidity and operational needs efficiently. And finally, growth capital. This will help you in planning for scaling or expansion thing. So here is an example of how your goals are set. So we have projected a 20 crore increase in sale so that the gross margin has shown an increase of 3%, that is from 26% to 29%. You can clearly see that the expenses are optimized, resulting in net profit of 7.6% to 10.5%. So these projections reflect our goal setting strategy. The strategies include revenue expansion, cost minimization, as well as enhancing your margin. Now let us look into each metrics in detail. So to earn from a business, sales targets are the most direct path to income. So we'll have to set a structured approach for sales target so that we can easily monitor and assess your targets regularly. While looking into that thing, why sales targets has been important? What are the drivers? We'll look into that. The first one is focus and direction. When you have a clear focus and directions, your team will know what you are planning towards and they'll know what they have to work towards so that that individual goal will be achieved, which in turn results in the organizational goals. Performance evaluation and financial planning. This will help you check whether your sales have been aligned with profitability. Motivation and incentives. This will help your employees uh, energized in achieving their individual goals. Performance tracking and improvement. This will show whether your concern have been adapted to the goals that you have set. And all together, all these drivers work together and which will result in growth and expansion, which is nothing but our ultimate goal. So there are certain factors which influence sales while projecting. The first one is historic performance. While we are projecting sales, we can't just rely on guess. So we'll have to consider historic performance. We'll have to at least check previous 2 years sales trends and then set the target. So with historic performance and some estimated growth rate, we can set a target. The next one is seasons affecting sales. This plays a major role because these seasons are naturally performing seasons. Also, when you have launched a new product or added a new vertical or added a new location, they have to be considered because they'll play a major role in your sales. In the same, on the flip side, when any competitors have arrived in your location, that also have to reflect in your goal setting because this will have a negative impact on your sales. So, using these factors, we can create a realistic and more efficient plan so that it can be achieved effectively. So, it's time for an activity. So, my question is, how should sale target be fixed? Monthly, quarterly, or annually? I request you guys to answer in comment section. Okay, let's move on. So, many of you have said monthly, which is correct. This is how a target is fixed. Monthly, we will fix a target so that it will be more efficient to monitor as well as adjust in real time. The next metric we are going to look at is gross margin. So, gross margin goals drive business to focus on cost management and control. By controlling your cost, your overall financial health and competitiveness will be improved. So you can clearly see this illustration. In both the scenarios, sales as well as the gross profit remains same. But when you look at the scenario one, the net profit, there is a net loss of 5, and in scenario two, there is a net profit of 10. So when projecting your goals, set your gross margin targets based on your expected cost structure to ensure that your business will stay profitable. The factors that influence gross markets. Analyze existing sales and categorize it on the basis of these 4 buckets. So there are these 4 buckets where you can categorize your sales. High sales and high profit. This shows that your product is top performing. High sale and low profit. This shows that there is some issue in costing. Low sale and high profit. Here it states that it is a niche product which needs a volume push. Low sale and low product, this is most of the time the candidate of discontinuation. So once you have categorized your products into these buckets, the next step is to tailor your strategies, how to handle your competitors. This is mainly important where the price wars are common. In the same way, you need to assess the gross margin while introducing your new product. You will have to assess whether this actually adds profit or it just adds volume to the business. And on the other side, discontinuation of existing products. While you are going to discontinue an existing product, you'll have to check whether, even though if it is of low sales, it might give you a high profit. So it is important to check this. In this way, if we have a proper plan, it is easily achievable to our targets. Next, the topic will be handed over by Sudarshan. Thank you.
So, thank you, Pratiksha. Good evening, everyone. So, yeah. Now let us take some time to understand what expense budgeting truly means and how it impacts various areas of our business. So, before delving into what expense budgeting is, we'll take up 2 questions, which is what is expense budgeting and why it matters. So, basically, expense budgeting refers to the process of planning and allocating funds for various expenses incurred by an individual or an organization or for a particular project for a given period of time. It involves estimating and setting financial targets for different expense categories such as operating expenses, your employee costs, your marketing expenses, your research and development expenses, and other utility costs. But will then comes the question of why do we even need to budget for our expenses? Because if we don't track our expenses, we lose control over our business. It's not just about cutting costs, rather, it's about reducing your cost with a purpose. When you budget, you actually are planning your business strategy. You can decide where you want to spend more and wherever you have to save and how much you have to improve on your efficiency. Budgeting also helps us benchmark ourselves to the industry. Here, this prompts us a question of are we spending too much on our marketing compared to others in our industry, or are we too little on our training to our employees? When done right, expense budgeting leads to smarter investment decisions, sustainable business growth, and constant improvement. Now, we'll talk about the core benefits of expense budgeting. When you run a business, it is easy to focus only on revenue. But have you ever considered how many opportunities you're missing but not budgeting your expenses carefully? Let me explain. By making an expense budget, one can improve productivity. We will get to know which areas need support and which are overfunded. It also helps us align our operations with our long term goals. For example, if you plan to expand in the first month of the next year, your budgeting today should need to reflect that in that direction. Ultimately, budgeting isn't about restrictions, it is about clarity, control, and focused growth. Now, we'll see some key reasons as to why budgeting are important. The first one being cost control, the next being strategic planning. Next comes your efficiency and your productivity, comes your benchmarking and your industry standards, investment and growth, and finally your continuous improvement. Moving forward, we will look into an understanding of the relationship between income and expense with the help of an example. A retail clothing store wants to increase their sales by 20% in the next month. To do this, they plan to run advertisements and promotions, which increases their marketing expenses. Now imagine they spend a lot, but sales don't go up by 20%. What happens? Their profits decline. That's why understanding the relationship between expense and income is critical. Don't just assume that spending more brings you better results. You need to monitor and measure the impact of every rupee you spend. In short, spending more doesn't always mean earning more. Smart budgeting and strategic expense management are key to ensuring that every rupee spent contributes meaningfully to both our sales and our gross profit margin. Moving on, we look at the types of expenses and its effect on our businesses. In order to budget better, you must know what kind of expenses you are dealing with. These can be classified broadly into three. The first one being your fixed expenses. Fixed expenses are those expenses which remain constant, irrespective of your level of business operations. And the examples of fixed expenses would be your rent, interest on loans, and etc. The next type of expense is your variable expenses. Variable expenses are those expenses which change with respect to your level of business volume. If at all you increase your level of production, your variable expenses increases accordingly. So your examples of variable expenses would be advertisement expense, sales commission, incentive to employees, and others. And the final type of expense would be your semi-variable expense. Semi-variable expenses are those expenses which has characteristics of both fixed as well as variable expenses. A best example of semi-variable expense would be your electricity charges, wherein if at all in our line of business, during the seasonal month, the electricity charges would be much higher compared to the non-seasonal months. This shows that the fixed electricity charges are on a fixed rate during the non-season months, and during the season months, the electricity charges increases proportionately. So this way, electricity charge becomes a semi-variable expense. Knowing this helps you to decide where you have control and where you need to be cautious. For example, if variable costs are too high, you must ensure that they are actually driving your sales. Next, we look at the key factors which should be considered for expense budgeting. Now, most business owners make a simple mistake. They look at income first and then manage whatever is left as profit. But usually, we should follow a mantra wherein your income minus your profit is your expense. So you should have your profit as your end goal, and the expenses is the one thing which is left behind, and you should accordingly plan within that budget. Also, don't lump all your expenses into one big category. Create a detailed accounts tree. This helps you analyze and compare expenses easily. And always compare your costs with your particular industry benchmark. It tells you whether you're overspending or underinvesting, or rather, it tells you whether you're overperforming compared to your industry competitors or whether you're underperforming compared to your industry competitors. Moving on, we look at the essentials for the preparation of a budget. Now, how do you actually prepare a good budget? The first thing would be to maintain proper books of accounts. Effective expense budgeting starts with maintenance of proper books of accounts, which ensures that all financial data is reliable and traceable. The next would be to set realistic goals and allocate your resources based on your past performance, which actually helps in planning more accurately. Next comes your regularizing your recording of journal entries in your books of accounts on a monthly basis, which gives us a clarity onto the spending patterns and helps us in timely adjustments. Finally, implementing a strong monitoring and review mechanism ensures accountability and keeps spending aligned with your overall budget. You need to track and tweak your plans or budgets on a regular basis. Together, these essentials form the backbone of a disciplined budgeting process. Now we have a Q&A session wherein do you have a proper structuring of books of accounts? So yeah, from the results of the poll, I can see that around 81% of the members state that they have good accounting system in place. First, we'll understand as to why maintenance of proper books of accounts is important. Proper accounting isn't just for tax filing, it is rather for your business decision making. With organized books of accounts, you get a clarity on where your money is going. You can identify patterns, control leaks, and plan better. Without it, your business will operate on guesswork. That's why a structured system is the foundation of budgeting, costing, and forecasting. Now let us take a look at the sample accounts tree of a company. So this is the sample books of accounts of a company before the structuring of the expenses. If we can take a look at the slide, we can see that there are 110 more ledgers which are not yet displayed in the given system. So there is no clarity and reviewing of expenses becomes a headache. This kind of setup makes it hard to track patterns or control costs. Even if they wanted to cut expenses, they wouldn't even know where to start. So this way, a solution for this would be to restructure your books of accounts in the following manner. Wherein the expenses are cleanly categorized, you can immediately see which cost relates to admin, marketing, operations, and etc. This setup helps in budgeting your cost control and audit readiness. If your current accounting books doesn't look like this, it's high time you consider restructuring it. So to wrap it up, profit is not a result of luck or hard work alone. It's a result of careful planning. Start with how much you want to earn and then work backwards towards your spending. Track your expenses, structure your accounts, and use your data to take control over your business future. Now over to Mr. Ajay.
So, thank you, Sudarshan. Good evening, participants. So, we'll see working capital cycle and what it means. So, working capital cycle means converting the total net work capital into cash. So, it simply means converting your inventory into cash by managing two important factors. One is receivables and another is payables. So, for example, if you are investing X amount of into your business, so the time taken to convert it back as a cash is called working capital cycle, and the period is denoted as working capital cycle days. So working capital cycle days is denoted by inventory days plus receivable days minus payable days. So inventory days is the time taken by the organization to convert its inventory into sales. So receivable days means the time taken by the organization to collect back its receivables. So payable days means the time taken by the organization to repay its creditors. So in simpler terms, working capital cycle efficiency is based on three important metrics. One, based on quick selling of inventories, followed by collecting its receivables from its customer and paying its bill on strategically. So this will help in optimizing their cash flow. So below example illustrates this working capital cycle very clearly. So the cash which is invested in the business is used for purchasing the raw material which is taken for production and FG is produced, where it is sold in the market for the customer and the cash is being collected. So as I mentioned earlier, cash which has invested in the business has become cash. So this process is called working capital cycle. And the time taken for this cycle is called working capital cycle days. So based on the understanding, we'll see an activity. So whether working capital cycle days is more is beneficial or less is beneficial. There'll be a poll popping on your screen. Kindly answer. So I can see the response that 44% have told more and 56% have told less. So we'll come to a conclusion based on the illustration given next slide. So we have two scenarios here. Scenario one, where the working capital cycle days is 50. In scenario two, working capital cycle days is 45. So many told 15, many told 45, but we'll go in depth analysis and come to a conclusion. So both in scenario one as well as scenario two, the inventory days are 60. Okay. So in data days, scenario one has 45 and followed by data days in scenario two is 30. So here the scenario 2 as an upper ramp towards the scenario 1. In creditor days, scenario 1 has 90 days, but in scenario 2, it has 45 days. What it means? So scenario 1 is enjoying the creditor's money without paying, right? So say example, if scenario 1 is a market leader, like example DMart. So scenario 2 is a small retail shop, a supermarket, right? So in scenario 1 is suitable for the businesses with strong supplier relationship and bargaining power and allows delay payment, but the same cannot be expected from the scenario 2. But scenario 2 is best for the businesses that rely on quick collection and considering cash inflow, even if supplier credit is limited. So what it is important here is optimizing this creditor cycle. So delaying payment too long can harmful for the supplier, while paying too early may strain your liquidity and affect your cash flow. So it is important to maintain a good relationship with the suppliers. So the answer for the previous question, which is best, having a more or less, this depends upon their business type in the industry. So theoretically, less is the answer, but practically based on many situations like industry, business model, market condition, and many other. So maintaining the right balance of working capital is the key to earn more and achieve long-term success. So working capital cycle is important with an ultimate objective to earn more from your business, right? So the objective of the businessman is to find the average working capital cycle days and to maintain it, not to go beyond or below the average working capital cycle days. So the ultimate objective is to earn more by maintaining the average working capital cycle days at an optimum level. So now comes the question, what is the ideal working capital, right? To answer that, we need to look some basic financial metric that helps to measure how effective we are managing it. So we have two metrics, one return on investment and two is net profit. So in this both, which is the best? There will be a poll popping in your screen. Kindly give your response. So, which financial metric is more suitable for evaluating the effectiveness of managing ideal working capital cycle? Option 1 is gross profit, option 2 is net profit, option 3 is return on investment. So 10% have told gross profit, 23% told net profit, and 67% told return on investment. So the right answer is return on investment. Let me tell you why. Net profit tells you how much you are earning, but return on investment tells you you are using your capital in how effective way and how you are earning profit out of it. So let's understand both the return on investment as well as net profit by let's understand both return on investment and net profit. Why return on investment is more effective measure when evaluating the ideal working capital in upcoming slides. So net profit is the portion from the sales, right? So it is net income divided by the revenue. It is the part from your sales. Whereas return on investment means it is the return from your capital, what you have invested. So the investor and promoter mainly need to focus on return on investment. The formula goes like return on investment, net return divided by cost of investment. So to prove return on investment is the best tool than the net profit, let's see an illustration, then come to a conclusion. So we have three similar business types here. So premium location, mid-size compact, compact format. So all has their net profits same as 10%. So the tier 1 city premium location has invested 1.5 crores and the working capital need is 60 lakhs. So the return on investment is 10%, whereas the mid-size format has earned 12.5% and the compact format has earned 16.7%. The difference between the premium location and the compact location of 6.7% makes the difference of utilizing your capital in the more effective way, right? So while net profit shows your profit from operation by comparing your income to the revenue, but it does not reflect how effective capital being used. So return on investment goes a step forward to measure the return generated on the capital deployed. So it is essential for investor and the promoter who are focusing more on return on their money rather than the income from the income statement, right? So business may have a healthy net profit, but if the capital invested is too high, the return on investment could be still very poor, right? So that is why return on investment is superior and more statistical measure when evaluating the business performance. So business with a low net margin but a high asset turnover can deliver higher ROI. So this symbolizes high return on investment means capital is working effectively even if margin looks modest. So I believe that everyone can agree that return on investment is the best tool than net profit for evaluating your ideal working capital. So ultimate objective is to earn more from the business. So our objective should be set the working capital and evaluate it based on the return on investment and earn more. So your goal setting will work for you if budgets are aligned and being realistic, and you should to understand the relationship between the expenses, income, your gross margin as discussed earlier. So, and the major key important thing, maintaining the books of accounts, how it has been maintained, updating it in real time and maintaining day-to-day basis to have the data ready for analysis. And periodic review of budget. Yes, your budget need to be compared with the actual, and the deviation need to be worked. If the deviation is like in a positive side, you need to reward yourself. If the deviation is against your side, you need to work on why it has failed. So while preparing budget, we already discussed about that this is not, the scope is not restricted to finance department. It should be depend on everybody is starts from the salesperson to the managing director. Everybody should be assigned a role in achieving the sales or the target goal setting what we have discussed. So to summarize, everybody wants to earn from the business, right? So you need to start knowing why business fail. From the failure, you need to learn and we need to fix it, right? And second, understand the relationship between your expenses and your margin to stay profitable, and setting the realistic sales target and to guide your growth, right? And then managing your working capital efficiency by how already mentioned that return on investment. So remember, smart financial decision, not just the hard work. So thank you. We truly appreciate your time and attention. We hope this session helped you viewing your business from the broader, more strategical angle. So if you have any queries or need further assistance, please to reach out using the contact detail displayed on the screen. So wishing you the continuous growth and success in your business journey. Thank you. Thank you because of our team.